Welcome back to another episode of On the House with Spartan Invest. We have a special guest today. He has been on the podcast a couple of times. We've mentioned neighborhood loans. This is Greg Iverson. Thank you so much for joining us.
Thank you for having me back.
Yes, we're excited. And we're going to talk about interest rates because, what else are we going to talk about, Greg? I mean, what else is going on? Not much.
Exactly. That's about all anybody wants to know about these days, and obviously has a huge impact on what you do day to day, what I do
Absolutely.
day to day, and of course our audience, and consumers out there.
Absolutely. So, if you are a frequent listener, you know that Spartan Invest partners with neighborhood loans and some other lenders to offering a forward commitment. And what that is that's just our bulk buy down to the interest rate. So we purchase upfront a buy down to 5.5%, and that way our investors can lock in a 5.5% interest rate for a 30-year. We've been doing this together now for 2 years, I believe.
Yes, we are almost 2 years in October, I believe.
Yes.
Right?
Oh, that's correct. Yep. It was Halloween when we locked our first one together. So,
Yeah.
so I wanted you on today to talk about the rate cut and the Fed announcing that there's going to be multiple cuts. We're recording this towards the end of September, so there's already been one cut. And this doesn't necessarily pertain to Spartan Invest clients because we offer the forward commitment. So at any point, a Spartan client can lock in that 5.5% for the 30 years. But it does drive a lot of the market, a lot of investor activity, and owner occupant activity as well. So tell us a little bit about what you've seen this year, just in general in your industry.
Absolutely. So first off, on the forward commitment, I'm glad you mentioned that. So everything we're going to talk about today, I would say, is not as relevant if you are aligned with Spartan doing a forward commitment. That is kind of like the magic pill that takes away any of the market forces we're about to talk about. However, that being said, there was a rate cut. Lindsay, I know we talked about it a couple of weeks ago. They did end up cutting rates last year. I'm sorry, last year. Geez, last week by 25 basis points, which that was the belief overall of what was going to happen. I think there were a few that said, 50 basis
Mhm.
points, and even less probably that said zero. That was the consensus. The interesting thing when it relates to, and then I'll talk about what we're seeing going forward, but the interesting thing about that, and I'll just be totally honest, I did this job for at least a year and didn't actually totally understand this stuff, that when that cut is actually made, typically mortgage bonds, which is mortgage rates, have already priced that into their rate sheets. And what I mean by that is if rates are going to fall because there's a Fed cut, rates likely fell 30 days ago.
Right.
Now, in this case, that's actually what happened.
Hmm.
So we saw a lot of improvement about 30 days ago. And what's interesting for those that track this stuff is as it becomes more and more certain that we'll have a rate cut, it it prices into our rate sheet even more and more and more, to where, when that cut was made, we all thought, gosh, hopefully there weren't people that were thinking it was a 50 basis point cut and we would actually see rates pull back, which did not happen. Overall, it was a relatively stable day right around the cut. But typically, think of it this way: 30 to 90 days out from that meeting is usually when mortgage rates will start to react. So the next meeting is October 29th. That's being priced in right now. There's a probability I looked at before we jumped on this morning. It's at 90% right now of the belief that in October there is going to be a 25 basis point rate cut. So what that tells me is likely that's already been being factored in because of such a high probability. The rates we're seeing today are already assuming there is going to be a rate cut in October. That makes sense. It's all based on a futures market. And
Hmm.
so anytime the actual activity happens, it's the speculation leading up to it that causes that, you
Right.
know. The only other thing I'll throw out there, just because we're talking about the markets right now, this coming Friday. So today is Monday, September 22nd, when we're actually filming this. This coming Friday, PCE comes out, which is a measure of inflation, and that is incredibly important to mortgage bonds. It has been exponentially more important over these last several years, as that's really what the markets have studied and paid attention to, is what's going on with inflation,
Hmm.
and so So inflation, when that comes out Friday, the belief is depending on how that does come out, that'll signal if we'll have our two cuts this year, and likely we'll see some rate improvement. I would guess.
Right.
So
So just I know that this is a very challenging thing to speculate, and a lot of times investors are like, well, what do you think is going to happen? And they want to know. They want to know so they can try to plan. But in your opinion, and I know you watch it religiously, as the same as we do, but if inflation comes at a slightly elevated amount or more than they were originally projecting, because I know it's been the biggest topic of conversation and the biggest driver of what the Fed is going to do in the future, what do you think will happen? Do you think we'll still see two additional cuts? Because Powell has said that he does predict that 3 cuts this year before September, or at the beginning of September, I believe. So what are your thoughts in regards to if the inflation number is higher than what is anticipated?
yeah, that is a great question. So that's called coming in hot. So if that inflation reading comes in hot, which would be over, I believe that would signal. I think that's bad for rates. First off, I think that would cause rates to get worse, which in turn will likely either. I would say there'd still be one cut, but I think that would take it from being 2 cuts this year down to 1 cut. And I would say that's our biggest. That's what lenders are studying right now. I think that the consumers that are active in the market right now, I think they need to be studying this Friday PCE report as much as anything related to a Fed cut right now, especially since we're just coming off of Fed week last week.
Hmm.
Just to give you my overall view. And by the way, I should tell you I've been wrong on this lots and lots and lots of times, but I still keep getting into the batter's box. My gut tells me that we're seeing lower rates the last quarter of this year, the first quarter of next year. I think that's where we'll start to really see we've started to kind of see a slow, steady fall. I think these next 2 quarters will start to set up for a lower rate environment overall, not just an anomaly where we get low rates. Like last year, I think we had it for 2 weeks. We had incredible rates, and then they shot right back up. I think this is starting to set the stage for a lower rate environment. Which obviously a great thing for investors. Again, when we're doing the forward commitments, it's not as relevant of an
Right.
issue, but it's still, as an investor in general, it's important to know these things. And the cost of money, I'm an investor myself, Lindsay, I know you're an investor yourself. The cost of money is typically our greatest cost, and so
Right.
not only is a forward commitment just a huge tool to be able to leverage in your overall
Hmm.
plan, but of course, rates falling the way that they are, I think, sets up for better years to come for investment.
Right.
Although
Well,
the
it
last
just
several years have still been great. So,
Mhm.
but I think it's only going to get better, personally.
Well, I think the lower rate environment just signals a more investor friendly atmosphere and activity. So, I think it just engages more investors who may have been on the sidelines despite even offering a forward commitment. Because again, like that's where we don't want our investors to have to watch and monitor that volatility and price it day to day. We just eliminate that altogether. Talk, Greg,
Yeah.
about what this year has looked like in just the overall lending space. Have you seen applications dwindle? Have they picked back up in the last 30 days? What have you seen in total for 2025?
It's a great question. 2025 has been a better year than 2024 in terms of volume, in terms of applications. Refinance applications have picked up just recently. I think that trend will continue personally. As a company, we have been running about 90% purchase, 10% refinance over the last several years, which sounds great. And that's what's kept us alive. I would say a healthy mix for us is closer to about 25% refinance,
Hmm.
75% new purchase. As of last week, that's right where we were running. Now
Okay.
that's only for about the last month. So we're getting back in balance as far as that goes. But definitely for us as lenders, I would say volume wise, the worst is behind us. We started the year. I don't quote me. I couldn't tell you exactly, but we started the year in the mid sevens. I would say on a national average, 30-year fix,
Mm-hmm.
maybe 7.25 to 7.5. Now this is for a primary residence, but that's what's most frequently tracked. as of today, when I jumped on, we're at about 6.2 or so on that number. So that's a full 1% reduction in
Mm-hmm.
interest rate. Again, a six doesn't sound crazy great when you can get 5.5 on a forward commitment, or when you got 2 to 3% in COVID. But 1% drop in a year is very meaningful, and like I said, I mean, that's caused our refinance business to tick up 15%, and so it's a good sign, I would say, for even outside of the forward commitment. It's a great sign for anyone in the investment space, period, because real estate investors borrow money, they reposition assets, they restructure things, and so lower rates in general, it's great for anyone in real estate, us two being obviously two of those. When that happens, investors, owners may cash out to buy other properties,
Right.
and but they're really waiting for the opportune time. So what it does is it creates transaction volume goes up quite a bit, which is obviously great for those in the industry. But as an investor, that's a great. I grade my years on the years I was the most active buying properties,
Mm-hmm.
and this was one of those years. I was telling my wife last night, I said, when you have your head down and you're just doing, you don't think about it, but then you look up and say, wow, and this year we've added this to our portfolio, this number of properties, so on and so forth, and I really think the way other dynamics are set up, even outside of interest rates, but the tax favorability and things, I think these next several years for real estate investors it's our time. I really do think that. Yeah.
Well, I mean, that's great to hear in our industry. Just full disclosure, that's awesome to hear, because, like you said, the last couple of years have been a little trying, a little bit more difficult to move the needle with so much uncertainty. So
Mhm.
crystal ball, I know you talked about, hey, the next few years is going to be great, but with inventory at the levels, especially new construction, I think national average right now is we're at a 9.8 month supply of new construction. That's very different from market to market. And you and I are primarily in the Southeast. Am I correct with neighborhood loans? So, and Alabama
Yep.
is in the South, or I'm sorry, Spartan Invest is in the Southeast with Alabama, Georgia, and Tennessee. So those markets are different. But if you want to look at the country as a whole, we're sitting at 9.8 months supply. Do you think that this rate cut, or the moving towards more rate cuts, will boost buyers' confidence? Do you foresee that having an impact? Because I know a lot of permits, the sheer number of permits have dropped significantly
Mhm.
from builders over the last couple of months, just because of the heavy inventory. And just to kind of give you a reference point, back 2 years ago, new construction inventory was less than 4 months worth of supply. And again, we can
Mhm.
rehash all of the reasons as to why, but that's a very big increase of just supply out there in general. So do you think that this will lead to a hotter buy market on the owner occupant and investor side?
I really do. I think that home affordability is such an issue across the country.
Mhm.
I think Southeast, quite honestly, is less affected, and the Midwest, where I am, are less affected than the coast, certainly. But I think home affordability is still an issue. I think that as rates improve, not only does it make it purely to where it's more affordable, but your psyche changes. I think you're more bullish and excited. Let's grow our foundation, let's acquire properties, let's do things like that. I think it really spurs activity. The I would say that the downside concern in certain markets is, and you kind of touched on it, is it's an inventory thing. And how are we going to create more inventory? Now, here's what I believe, though, is these builders are borrowing money as well. And they're no fools. They're doing their homework, and they know what their buyers need in terms of affordability. And so I think what will happen as the Fed is cutting rates, a lot do not realize, and these markets can be incredibly confusing. But when the Fed is cutting rates, that's actually cutting rates of different types of borrowing. Mortgage rates just happen to react in a similar fashion at times. Those cuts are actually being cut. It's what banks borrow from each other
Mhm.
at those rates. And then ultimately, what more businesses would borrow at, I would say, like a,
Correct.
a builder, for instance, And so, my long winded way of saying, I think as those rates start to come down as well, builders can get more bullish. Ideally, they can build homes for a little bit less cost because their cost of money is less. as we know, you're in the business, Lindsay, you know better than I do, the cost of materials, the cost of labor,
Hmm.
everything, where, just building a house, it's gotten exponentially more expensive. And so
Absolutely.
there's probably a lot of builders that are looking at it and saying, am I going to stick my neck out? The house is this much more to build it nowadays, and my buyer is paying this much more for it because of rates. I think rates coming down on the mortgage side, but also that borrowing for more commercial type borrowing like that. Um, I do think that will help to create more inventory, which in a lot of cases is the issue. At least in a lot of markets. But if nothing else, I think it gets it back into the headlines. It gets people excited about real estate again. They see that, it's they can see the different pillars of the return in real estate when they're not saying, yeah, but I have to borrow at 8%. Let's be real. That you don't feel like you're making an investment when you're borrowing at a cost like that. And I think that's soon to go away.
All right, I'm gonna throw a curveball at you, Greg.
Let's
So
hear it.
in kind of doing a lot of research on where we are nationally and how we have shifted from a generational standpoint to more of a renter nation. Obviously, that is very beneficial for clients of Spartan Invest that want to buy turnkey real estate. But on the lending, purchasing, owner occupant side, it can be it can be detrimental. And I was curious at
Mhm.
what your takeaway is, or how you see the next 5 years playing out. So, just from the baby boomer generation, by the age of 35, over 75, I think it was like 77% of baby boomers owned a property. Compare that to
Mhm.
the millennial generation, where it's at 48%. Only 48% of millennials owned a home by the time that they were 35. And that
Yep.
shift, we're going to continue to see that go down. So, what are your thoughts on what that looks like, whether from the, I mean, definitely more on the lending space over the next 5 years?
Well, and this could be wishful thinking, but I hope it comes true. I think it sets up even better and better and better for the landlord. I mean, the stats you gave, those are obviously accurate stats. You can just feel it and sense it.
Yeah.
If I'm talking to someone of my parents' generation, they were baby boomers, even someone of my generation, you had to buy. That's just what you
Hmm.
had to do. Even if you asked me at the time why I even bought the property, I couldn't have told you anything other than, well, that's what you have to do.
That's what you do.
Like that. Yeah, that like when I got out of college, that was ingrained in my head. That's how the baby boomers were a lot more. That was the American dream. Pay the house off, take care of it, all that sort of thing. That has started to go into the rearview mirror, as obviously things have changed. People are more transient, I guess we could say, in a good way, But I think the millennial generation now is seeing that, what, I can rent here, I can go live in that locale, or I can live wherever I want. I can afford the rent, and I can save my money in other places. And a lot of those individuals are actually clients of ours that are buying rental property because they believe in renting or in rental property. They just don't want to actually own their own primary. So I personally see that continuing. I think that it's I think it's just looked at a lot differently, and I think that also millennials and what is it,
Gen
Gen Z
Z.
behind them.
Gen Z.
Yes, I think that this is not a statistic. This is me talking to them as clients and gauging how they feel about things. Both generations to me seem to be more conservative and more willing to wait and save their money and understand. They have access to so much more information than I think either one of our generations had at that stage. Wait and understand what's going on, soak up the information first.
Hmm.
For me, it was like buy the property in your 20s because then it's paid off in your 50s and that whole thing. Like it was totally a time game. And I think it's reversing where at least this is a sense we get from a lot of our clients. They're willing to do that research and sit back longer before
Hmm.
they take action. And so all that to say, I think that sets up better and better and better for landlords. The higher, obviously, of the population that rents, the better off things are going to be for that landlord. I will add this, and this is a little bit of a curveball probably, but I also think the good landlords. I think that the ones that if we're just flooding landlords into the market, I think the Spartan Invests of the world have a significant competitive advantage. And I have not always looked at it this way, but because they're professionally managed, I think it's looked at as a whole different business nowadays. And if millennials and Gen Z are more commonly renting, and they have options, let's be real,
Right.
they have options all over the place. I think running a professional organization, I think for the audience out there listening, aligning yourselves with a Spartan Invest, that's where I think you'll be a lot more successful because it's being professionally managed. You can attract the right tenants, so on and so forth.
You
So,
just been putting the process in place. I completely agree with that, and it's not even I wasn't even thinking that, but you're absolutely right in that if that is where we are headed, just in the future generations, if we are going to be more of a renter nation, then the good landlords are definitely going to have to set themselves apart. And so being in that professional arena is going to be a big game changer. If obviously if the client has more options in where they're choosing to who they're choosing to rent from. Greg, so I know you mentioned inflation, that the number this Friday that we're waiting on. Is there anything else that you could tell investors to watch, look out for, monitor, maybe if they're interested in watching or kind of staying in tune with whether or not rates are going to continue to decline, or if they potentially are there not going to be any more cuts? Is there anything else that you could give that they could
it's
keep an eye on?
Lindsay, that's a great question. So I would say Mortgage News Daily. If you just type that into a search bar, it's a consumer site. It's actually the site I go to daily. Has great information just on mortgage-backed securities, which is essentially the mortgage market. I personally think that's about the best out there. Outside of tracking inflation, especially right now, what I would be tracking is the probability of rate cuts, and it changes. And so week to week, CME Group, I believe, is who we follow. So CME Group. But as that probability increases that there's a Fed rate cut, then more and more and more of that is being factored into interest rates. And so what I mean by that is, like I told you, it's about a 90% belief that rates will be cut at the end of October. That tells me that's already in our rates. The only thing that can shake it up now is that inflation number.
Mm-hmm.
But I would follow what the probability, and I would do that over the next 6 months to a year. I would say that's going to be a very hot topic for mortgage rates, but seeing what that probability is. The other thing I'll say, Lindsay, I think it's important for consumers to track interest rates, to track overall market fundamentals. However, I think that it's also just as important in lining yourself up with the right individuals, buying the right properties, and having a good overall plan. I mentioned, your cost of borrowing is one of your greatest costs in
Right.
investing in real estate. So I get it as an investor for sure, but there's more to the picture, and I think a lot of people sometimes get blinders on, and it's, well, rates aren't good enough to buy. Lindsay, I think I just told you, this is one of the more active years that I've had in a long time in terms of buying property. And I know what rates are, and I know they weren't what they were when I was buying the properties in 2020. But I think looking at it from a different angle at times, and
Right.
seeing some of those tax advantages, seeing that just overall the principal pay down,
Mm-hmm.
that's creating wealth over time, and you're not paying a tax bill each time that happens. And so again, while I think rates are crucial, I'm a lender. It's a big part of it. I always remind people, because I have to remind myself, that it's dollars, and an interest rate is just a percentage. It's just a number with a percent behind it. It's not all of the dollars that are involved in that entire transaction. And there's other pieces to be mindful of. And again, to bring it all full circle, to line yourself up with the right companies, the right advisors, the right friends, the right investor network of people that are living and breathing the same thing every day. I think it's
Yeah.
critical.
Absolutely. No, that's a really good piece of advice. And Greg, we could talk for an additional 30 minutes on how it is important for investors to look at the deal and not necessarily pay this close of attention to the rate, because like you said, you're purchasing more and more, because what happens when rates go down, when rates go up, prices come down. And so you're not overpaying. The second rates, if the rates were to drop 3% or 4%, or it would be a frenzy. Prices would shoot up.
Be too late.
The whole song and dance, we've talked about that a lot. We could talk about that for another 30 minutes, but I won't hold you. Thank you so much, Greg, for joining us today to talk about the rates and Fed and everything that's going on in the market.
My pleasure, Lindsay. Thank you.
All right. And that's On the House with Spartan Invest.